Good morning from our world headquarters in New York. I'm Manus Granny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
President Biden is set to visit Israel tomorrow, then travel to Jordan for talks in what's being called a critical moment for the region and for the world. Meanwhile, on Capitol Hill, Representative Jim Jordan edges closer to becoming the next U.S. House Speaker, but a band of Republican holdouts continues to threaten his bid. And Russia's Vladimir Putin arrives in China on a rare international trip for talks with Xi Jinping. The U.S. presses Beijing to help reduce the tensions in the Middle East. Well, we have breaking news at the top of the hour here on the German ZEW investor expectations. They rise to -1 from -9. Now, we'll reflect on that in a moment. Let's just have a look at the euro. If I turned the right way, we'd get there. It's a small move higher. Still, the consensus is, of course, that you may well move towards parity and a stronger dollar. Now, there's a huge presumption and preemptive mood in the bond market yesterday, up by 9 basis points. We build on that this morning. Yields are rising. You've got one of the most virulent bond markets that you've seen since the pandemic. Swings of 2% at the longer end of the curve. Have you had bond capitulation? As Stephen Major would say, Kalanovic over at JP Morgan says he's adding 1% back to his bond portfolio, but he's not convinced that the bottom is in. And the narrative is this, is whether you really believe there has been a cathartic capitulation in the bond market. The oil market has decided to view this move by Biden and indeed by Putin. Putin's spoken to all of the Middle East leaders. Biden, we understand, is set to go to Israel tomorrow. That groundswell of global diplomacy is what these markets are trying to front run. It is very presumptive, it's very preemptive, and you've got to be a brave person to presume that diplomacy will work. Copper, I put that in there. You're going to get a heap of news coming through from China. Citi are worried about China. They have a huge no doubt. The skew is to the downside, a heavy move to the downside over the next 6 to 12 months, and $7,500 is for them the target on LME copper. Danny, good morning.
Good morning, Manus. Yesterday's equity session was bizarre, given everything you just pointed out. When you have yields on the 10-year going to 4.7% rather, it is odd to see stocks, both S&P and the Nasdaq, rally more than 1%. Maybe it's more normal we give some of that back this morning. S&P futures down 0.25%. Same thing goes for Nasdaq 100 futures. We are on the cusp of the big tech earnings. According to Bloomberg Intelligence, the top 5 big tech stocks should gain about 34% year over year in their earnings. That is a very solid number, and it might just carry the entire equity index. That's going to kick off with Netflix and Tesla come Wednesday. European stocks, for their part, Manus, they're slightly lower. They are off the lows. It does seem, Manus, that some of the worst of the losses seem to ease after that ZEW survey doing better than expected.
Yeah, it's certainly above all estimates, -1.1. But of course, we've both focused in on that Bank of America report, Danny, and it is about this allocation, isn't it, around the asset classes. But still, the soft landing seems to be the top line narrative here.
Yeah, and I mean, when it comes to cash being added, 5.3% of AUM, that's the percentage, that moves up. According to Bank of America, that is the level historically that they feed into their buy indicator. That has gotten bearish enough for those out there that maybe you want to start looking at risk. Yep,
well, it certainly served them well since 2011. I think there you go. There's the allocation to cash. It goes up to 5.3%. And a weaker economy, still it's a toying cost, isn't it? And this is what Patrick Harker, we'll hear from him a little bit later on. He is concerned about this hiking path from the Fed kicking in on small businesses. Danny.
Yeah, it's certainly some of those fears, those hard landing fears still in there. Now, the other risk we have to contend with is what's happening in the Middle East. And on that note, U.S. President Joe Biden will travel to Israel tomorrow in a bid to prevent the conflict from engulfing the region. The visit comes as Gaza braces for an expected ground offensive.
This will be a long war. The price will be high, but we are going to win for Israel, for the Jewish people, and for the values that both countries believe in.
That was Israeli Defense Minister Yoav Gallant speaking after meeting with U.S. Secretary of State Antony Blinken, who you saw in that video, too. Let's get more with Bloomberg's Oliver Crook, who is in Tel Aviv for us. Oliver, Biden going to Israel. What does this mean for the latest diplomatic efforts?
Yeah, we expect the U.S. president to arrive tomorrow here in Tel Aviv, and really three messages. It's going to be one of support, one of deterrence, and one of diplomacy. The support is what we've heard from every U.S. official that has come to Tel Aviv, which is unflinching, unquestionable support for the state of Israel. Will we also see support, financial support, and military support, as Chuck Schumer was talking about just here in Tel Aviv on Sunday? Deterrence, we have a second aircraft carrier group, again, headed to the eastern Mediterranean, and this also to deter Iran and some of the rhetoric that has been sharpening around that we've heard, but also diplomacy. He's going to go to Jordan as well after his visit to Tel Aviv to meet with the president of Egypt, with the king of Jordan, and with the president of the Palestinian Authority, Mahmoud Abbas, to discuss kind of what the next steps are. And you have to imagine, number one on their agenda is going to be getting aid into Gaza, where the situation is absolutely dire. From what we understand, the aid is still stuck on the border with Egypt at the Rafah crossing point, but this is going to be the main concern, particularly for Arab leaders.
Well, where are we, Ollie, on the fighting between Israel and Hamas? There are these cessations, or the IDF have said that they'll refrain from targeting certain designated axes between 8 a.m. and 12 noon. It's coming up to that time for you. But on the wider conflict, where are we?
So what we understand is, again, the aerial assault has been basically unrelenting by Israeli forces into Gaza for more than a week now. I understand overnight there's also been some naval attacks onto targets within Gaza. But the real question is, Manis, when is this ground invasion going to take place? In what form is it going to take? How wide is it going to be? Is it going to be more tactical and limited? Is it going to be the full force of the Israeli military? And to that question, we really do not have the answer. Could it also be delayed by the presence of Chancellor Scholz from Germany, who will be here today, and President Biden tomorrow? We do not know. But as we heard from the defense minister of Israel, they are bracing for a long war and a costly war. And the question is, what comes next? We've heard from a Netanyahu advisor asked whether occupation is on the table. He said that that is not the preferred option for Israel. He did not rule it out. It's something Biden has cautioned against. And again, Manis, the last question is, what about the second front or multiple fronts of this war? Iran has been warning repeatedly that this war could expand beyond Gaza. We've had more and more exchange of fires on the northern border with Lebanon, so this is going to be one of the key risks that Biden is going to try to avoid. And again, he's arriving here in Tel Aviv, where we're getting air raid sirens at least 2 times a day. So really coming into a very complex situation that he needs to navigate.
And Oliver, Manis mentioned this idea of the safe corridor between certain hours of the day. Where do we stand on the evacuation of northern Gaza?
So this is going to be the big question. We have estimates of 600,000 people being displaced. I think it's very hard to get a read on the ground. Again, I think where most of the focus is going to be for the next 24 hours and 48 hours is on the border crossing with Egypt in Rafah, where the aid is lined up. Literally thousands of tons of aid is waiting there on the border. The Israelis have said that they are now going to create the conditions for that to go in, but their main concern is for that aid not to be commandeered by Hamas. There's also the question of foreigners within Gaza that they want to pull out. Many countries calling for that, which would go through Rafah. And then there's the question of refugees, which the Arab world overall has said they will not take.
There are many tentacles to this, and the aid is perhaps one of the most pressing ones, as you say, to make sure it does not fall into the hands of Hamas, but gets to the people of Gaza. Oliver, thank you very much. Oliver Crook, our reporter on the ground in Tel Aviv. So let's talk about the Federal Reserve. The officials there are signaling another rate increase. One of the Fed's biggest doves, Philadelphia Fed President Patrick Harker, spoke about whether the central bank should really continue to hike.
You might get ready for the fact that a lot of these firms may not make it with the higher rates, which again feeds back into my view that this is why we should hold rates steady. We should not at this point be thinking about any increases.
Our guest this morning is Octavio Marenzi, co-founder and CEO of Opimas. Octavio, the bond markets are trapped in many ways between the hell that is the war that we have just spent the first 5 minutes of this show talking about, and their role as a haven, and perhaps the future rate trajectory. Which is the most dominant force for the bond market right now?
Well, in my view, what's going to happen is the Fed at some stage in the not too distant future is going to be forced to carry on increasing interest rates. They've clearly said they want a 2% inflation rate. That's their target, has been their target for years. We're not really close to that. Inflation has been very, very sticky and very resistant. The only way they're going to get it down is by increasing rates further. So they might take a bit of a pause now, and they might sort of take a temperature check and check what's going on. But eventually they're going to have to come back to that. So I think we're going to see interest rates, particularly on the short end of the curve, carry on going up. I mean, if you look at the 1 and 3 month yields on US Treasuries now, we're up at like 5.6%. It's pretty high. The 30-year quite a bit lower than that. But that's been suffering at the long end as well. So I think we're going to see further rate hikes. That's going to be very bad for the bond market, bad for the equity market, and I think bad for the economy overall, as some firms simply can't pay those high interest rates anymore.
Well, let me play devil's advocate, Octavio, in that the rates that we've seen move higher, like Logan and Jefferson say, are equivalent to at least one rate hike, and therefore the Fed doesn't need to hike further than here. What do you make of that argument?
Well, yes, that's absolutely true. But I think the markets are doing this in anticipation of what the Fed is going to do. So basically, we're trying to figure out where is the Fed going to go? What are they going to do next? And I think the balance now looks like they are going to increase rates further. And that's basically what the market is saying. So, yes, the market itself is increasing. But, when you know a future price is going to be at a certain point, well, you approximate that price really quickly in the spot market. So, yes, absolutely. The bond market is, I suppose, sort of doing the work for the Fed. But it's really the Fed behind it and anticipation of what the Fed is going to do.
Octavio, the debate is this. Stephen Major was with the team yesterday and with Danny and I last week. He talked about a capitulation is what you've seen in pricing. You've got BlackRock, who are saying, look, it's gone too far for them. They're not tactically bullish, but they're at neutral. And then you have JP Morgan, who say add bonds as a defense. So in your eyes, we've not reached a capitulation point, or you've not seen that in the pricing in the bond market. There's going to be another wave of quite vicious selling?
Well, I mean, I'm not really sure entirely what the term capitulation means in this context, right? The Fed.
Well, I think the essence of capitulation is that bondholders have been forced to sell. Risk managers have forced liquidation. You have people who are long at 3.75. They can no longer carry the trade from a risk management point of view. Simple capitulation.
Well, so what I think is if you see things in those terms, clearly at the long end of the yield curve on the 30 years, the 20 years, and 10 years, we have seen a tremendous amount of pressure there. And basically those bond prices come down about 50%. So people put money into 30-year treasuries a couple of years ago have seen their money wiped out. Is that equivalent to capitulation? Does this mean now people are going to pour money into this a falling asset? I don't think so. I think it's got further to fall. I don't think there has been a capitulation. I don't really accept the argument behind that reasoning. It's basically up to the people who control the interest rates to determine where the bond prices are going to end up. And they're going to have to tighten the screws further, I'm afraid.
All right, Octavio, we also have some bank earnings to work through. Stay with us. Octavio Marenzi of Opimas. First, though, let's get some other top stories that are trending on the terminal this morning. The clock is ticking for Country Garden to avert its first ever public dollar bond default. The builder, which has become a symbol of China's broader property debt crisis, must pay a $15.4 million coupon by the end of a 30-day grace period that ends October 17th to 18th, or a default can be called.
Rolls-Royce plans to eliminate as many as 2,500 positions worldwide. That is 6% of the global staff. The CEO of the UK manufacturer is streamlining the workforce in preparation for an upswing in demand for large aircraft engines. A representative for the company declined to comment.
And UK wage growth slipped in the 3 months to August to 7.8% from a year earlier. That's down from a revised 7.9% in July. It's also the fastest since the data series began in 2001. This data indicates a cooling of labor market pressures that will make it easier for the Bank of England to keep interest rates on hold next month.
Coming up, the House Speaker role, it's still vacant. Congressman Jim Jordan is getting closer to winning the gamble. We discuss. And as the war between Israel and Hamas escalates, we discuss how it could bring the world economy to a global recession on Bloomberg.
Welcome back to Bloomberg Brief. I'm Danny Berger in London alongside Manish Cranny in New York. Now, bank earnings in the U.S. continue. We've got Goldman Sachs and Bank of America reporting today after the bell, and then Morgan Stanley will be reporting tomorrow. Of course, we've already gotten J.P. Morgan, Wells, and Citi. Octavio Marenzi, Opimas CEO, is still with us. Octavio, I'm actually going to steal your own question that you told us in the break. You said, look, earnings are good. I'm sorry to do this to you, Octavio. You said earnings are good so far, but can they continue to be? What do you make of it? Is this as good as it gets for the big banks?
Well, it's not. I'm delighted to be answering my own question. So I think what we've really seen is over the course of the past year and a half, we've seen the main story in the banking industry being net interest margin going up. Basically, people are leaving money in their checking and savings accounts, getting very low interest rates on them, at the same time as banks are charging much more on the loans. And of course, net interest margin has exploded as a result of that. Now, that game has carried on much, much longer than I expected it would. I thought depositors would be much more aggressive in terms of moving their money out of those savings and checkings accounts and current accounts into money market funds, into bond funds, or into bonds directly. But they've been much, much more reluctant to do that, particularly sort of the large banks, at the Bank of Americas, the JP Morgans, and the Wells Fargos. But we are seeing that come to an end now. So deposits are starting to go down. People are starting to pull money out. But bear in mind, the overall level of deposits in the US banking sector are still much, much higher than they were before the pandemic. So we've still got an unusually large number of deposits in the US banking sector. But that is starting to change now. And as that changes, there's going to be pressure on net interest margin, and that is going to put a cloud on the horizon for the US bank earnings story. And it's very hard to see where the growth is going to come to in the future. So that's basically the story. There's not going to be a new engine for growth, or it's not obvious at this stage what that's going to be, if there really is anything out there. So
the headwinds are mounting, and what you really want to worry about is when I'm actually Googling how to actually buy T-bills at an auction as a private that's actually when we all want to shudder and say this is some kind of a capitulation point. But I look at Jane Fraser and I look at the announcements that she made. I mean, the stock's off over the past couple of days. This woman is just hitting her stride. 7,000 jobs are to go, $650 million in terms of severance. Do you think that you're going to see a step change at Citi relative to Wells, relative to B of A? Is there a way of differentiating between Fraser and her peers?
Well, I think Citibank is a very different kind of institution from some of the others. First of all, they've got much, much larger international operations. They've got a very different kind of exposure set, and they're trying to sort of roll back. Just this year, they got basically rid of their Taiwan operations. Jane Fraser herself, for a long time, was in charge of Mexico and Latin America, so she's well acquainted with those markets as well. So Citigroup has an unusual exposure in that way that many of the other US banks don't, who are much more domestically focused than Citigroup is. But I think Jane Fraser has a real problem. If you look back to when she took over the bank, which is in March of 2021. Basically, the Citibank share price back then was about $75 a share. It's come down over 40% since then. Now, that is what most of the board of directors is going to hold her to task for, and she's going to have to demonstrate that she can turn that around. So everything she's doing now is designed to prop up the share price and move in the right direction. But it's a tough wait. It's a long way to go. Once you're down 40%, to get that back is really, really hard indeed.
I actually have a question for you, Manis. I mean, is the clubbing world forever changed because of this earnings season? Now that DJ Soul is no longer, he had to throw in the towel. I mean, what's going on?
He's just, you know what? My renaissance just hadn't arrived. I think that's the point. I think my days on Ibiza were long gone.
There's an open spot now.
No, there's an open spot. I think maybe we can do double decks, Dan.
I think we'd be pretty good. I don't know. I'm sure Octavio would listen to that. Octavio, what do you make of this? Look, I know we can laugh about this, but
go on.
Listen, I'm shocked and saddened to hear this news. I hadn't heard this before just right now, so I'm devastated that.
What's it going to do for him? What's it going to do for his market persona? In all seriousness, though, this is about brand Solomon, isn't it? A slightly more serious note. Bit of sobriety there, Danny. This is about brand Solomon, isn't it?
Absolutely. I mean, he's got a brand problem, right? And he's trying to address this now. I mean, not only the DJing always looked a bit weird, but it was kind of amusing and charming in a certain way. I think perhaps more seriously is the sense that a lot of people within the organization find him very difficult to work with and deal with. And so I think that's more of a perception problem really than perhaps the reality. But so he is trying to address that. And I think he's going to do other sort of persona changes and marketing, branding changes in the coming months as he tries to get a handle on that. But I think it's all about that. Yeah, its own personal marketing and branding.
Internal communication, external communication. Danny, that's called inner voice and outer voice. Octavio, thank you very much. Opimas CEO Octavio Marenzi, our guest this morning on the banks and macro on Bloomberg. Quick check on the commodity board. You're going to get a massive pile of information from China over the next 24 hours. Dr. Copper is down by 0.6%. Goldman's and Citi are bearish on this. LME inventories are at a 2-year high. Danny.
Yeah, and it might be another story, though, for the precious metals. Kalanovic, we talked about his call. Among it, he also says now is the time to buy gold with those geopolitical risks. Gold had its best week last week, Manus, since March of this year.
You're giving me a hint for what to do with the dollars and buy. It's nearly Christmas, Danny. But anyway, coming up, we're going to talk politics. The House Speaker role, it's vacant. Congressman Jim Jordan, will he win the gavel? Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. President Biden is set to visit Israel tomorrow, then travel to Jordan for talks in what's being called a critical moment for the region and for the world. Meanwhile, on Capitol Hill, Representative Jim Jordan edges closer to becoming the next U.S. House Speaker, but a band of Republican holdouts continue to threaten his bid. And Russia's Vladimir Putin arrives in China on a rare international trip for talks with Xi Jinping. The U.S. presses Beijing to help reduce tensions in the Middle East. Now, a more calm equity market to slightly lower after yesterday, despite the fact we had bond yields, 10-year yields go back above 4.7%. We had equities gain more than 1%. It was a strange day, capped by Marko Kalanovic, for example, saying it's time to reduce risk. Despite that, S&P and NASDAQ futures down about 0.2%. We're on the cusp of big tech earnings, ones that Bloomberg Intelligence figures will help lift this overall S&P 500 benchmark. That's going to kick off with both Netflix and Tesla on Wednesday. Meanwhile, European stocks, Manus, just slightly higher following the Asia session higher. You broke the ZEW numbers earlier, better than expected coming out of that German investor survey. That does seem to have slightly lifted European equities.
And don't forget, Union Bancaire Privé yesterday said to us, we're already in a policy mistake in Europe. Diplomacy is what the world is looking at, and the bond market is trying to front run. So you've got this rise in yields yesterday by 9 basis points. It continues this morning on the 10-year. You're looking a March higher. We've just had Octavio Marenzi at Opimas saying, no, this is not a capitulation in bonds. You're going to see significantly higher rates. This is just hopeful anticipation of bulls that believe that you've seen the worst. Stephen Major talking about a capitulation yesterday. JP Morgan, Kalanovic adding 1% to his bond portfolio, adding back, but he's not convinced that the bottom is in. Capitulation is not there. That's the latest line on the bonds. The oil market is rising on the hope that diplomacy from Biden going to Israel, from Putin talking to all of the Middle East leaders will work. The risk is, of course, a global recession. We catch up with our chief economist, Ziad Daoud, in terms of extrapolating the scenarios and the oil prices. But the oil market for the moment up 0.3%. Mizuho say 100 to 120 is not our base case, but it is a growing risk. And then we've already flagged the metals to you, down by 0.7%. You're looking at Citi, you're looking at Goldman Sachs, all getting much more negative. 7,500, heavily skewed to the downside. But Danny, it is about positions, and it's about position shifting from Bank of America and some of the tail risks.
Yeah, I mean, we were just talking to Octavio Marenzi at Opimas, who wouldn't touch duration. This is the risk. This is the top risk from the Bank of America survey. 31% of respondents say that the biggest tail risk is that high inflation keeps central banks more hawkish. Manus, in that environment, it is hard to justify buying the long end. That is a risk that yields continue to move higher.
Yeah, but there is the building consensus, Danny, that, of course, the soft landing is in the 59% see a soft landing. Danny.
All right, let's move on to U.S. politics, Manus, because Representative Jim Jordan has picked up critical support in his bid for House Speaker. Joining us now is our very own Kriti Gupta. Kriti, great to talk to you. Great to have you on Bloomberg Brief. All right, Jim Jordan, how close is he to becoming Speaker at this point?
Very close and very far at the same time. And let me explain here. Look, Jim Jordan is the very controversial GOP candidate. He was endorsed by President Trump. His politics are thought of as very, very far right. So on kind of this last Hail Mary that you're seeing from the Republicans, this is kind of their last shot. And he is going around. He's making the concessions specifically around defense spending, which seem to be, of course, of all the more importance given the Israel-Hamas conflict as well. So he is actually getting close in terms of rallying his support. That being said, it only takes 4 people to vote against him that Hakeem Jeffries, then of the Democratic Party, takes over as Speaker. So again, it's a very slim win if he does win, but on track to get there at the moment.
Pretty good to see a very colourful imagery there, the last Hail Mary. But on a slightly more serious note, of course, he is very pro-defence spending. How will that play into the Israel aid?
Well, I think the number you need to know, Manis, is $3 billion. That's how much annually the U.S. contributes to Israeli defense aid at the moment. The question is how much more. You're already seeing President Biden kind of move some of his actual warships over to the area that is under presidential direction, for lack of a better term. But what you still need is that congressional spending, mostly on the humanitarian side, less on the defense side. And that's where the House Speaker really needs to kind of come to some sort of fruition, because that is the part where you actually need the votes to come through. And again, the Republicans will actually support that bid, given that they are historically pro-defense spending. So that's not really the issue. But again, it is kind of all held up in Congress in a similar way that Ukrainian aid is. The difference is that Israel is actually a close American ally, whereas Ukraine isn't.
Well, in the meantime, you have President Biden, who's set to visit Israel, is set to visit Jordan. Is this about politics? Is this about acting as a broker of sorts? What's the hope that the White House is getting out of this?
Well, the word I've been hearing a lot is deterrent. And the idea here simply being that's not just about Antony Blinken. They're quite literally bringing out the bigger players. And remember, this is the second time that President Biden has visited an active war zone. He did it in Ukraine, in Kyiv as well. And look, he's not just going to Israel. He's going to Jordan as well, where he is going to be meeting the presidents of Egypt and, of course, the Palestinian Authority President Mahmoud Abbas as well. So this isn't just about deterring, although that is a big part of it. A lot of people are saying, a lot of political strategists are saying that the longer there is a U.S. official in the area, the longer the ground offensive will be held off. But again, there is also talk about humanitarian aid, convincing Egypt to take on a more kind of humanitarian approach when they're really hesitating to take on more refugees. Perhaps President Biden is kind of the convincing factor.
OK, Kriti, thank you very much. And at the same time, you have Putin talking to those Middle East leaders as well, trying to build that narrative around a consensus for some kind of a ceasefire. So it is a real global approach at this juncture. Kriti Gupta covering the very latest on President Biden, his trip to Israel, and of course, the political state of affairs on Capitol Hill. Well, the Secretary of State, Antony Blinken, spoke about the president's agenda in Tel Aviv.
He's coming here at a critical moment for Israel, for the region, and for the world. And he's coming here to do the following. First, the president will reaffirm the United States' solidarity with Israel and our ironclad commitment to its security. Second, President Biden will underscore our crystal clear message to any actor, state or non-state, trying to take advantage of this crisis to attack Israel. Don't.
Message from Antony Blinken to the region. For more on what this war may mean for the global economy, we've brought in our global chief emerging markets economist, Ziad Daoud. He joins us from Dubai. Ziad, good to have you with us. You stepped back and you tried to break this scenario down into 3 major scenarios. As you look at the world right now, Ziad, how does it look? Because you talk about it from an escalation point of view.
Sure, Manis. So the impact on the global economy from the current conflict in the Middle East depends on how wide the conflict expands. So we mapped out 3 scenarios. The narrowest scenario sees the conflict confined to Israel and Gaza. If that happens, then the human toll will be high. It's already quite high, but the impact on the global economy will be small and minimal. There's another scenario in which the conflict widens to neighboring countries like Lebanon and Syria. If that happens, Manis, then the impact on the global economy would be bigger. Our estimate is that the global economy would lose about $300 billion of output next year. And there is the more extreme scenario, the scenario of a direct conflict between Israel and Iran. If that materializes, then we expect the global economy to go into recession next year.
Ziad, as things stand, which of those three seems the most likely?
Well, financial markets are currently pricing somewhere between the first and the second. The latter scenario of a direct conflict between Iran and Israel seems unlikely so far, although it has a big sort of impact. So financial markets, if you look at oil prices, if you look at US bond deals, dollar, stock market, they've all moved in tandem with a contained conflict. We're also seeing political movements in terms of the visit of US Secretary of State, in terms of Biden's upcoming visit to the region, trying to contain the conflict and keep it confined to as narrow as possible. But there is a risk also of the conflict expanding. We've seen skirmish on the borders with Lebanon. We've seen the rhetoric is actually quite running high. So I think out of the three, the first two are the most likely. Maybe the first one is the most likely. But there's a serious risk of it expanding beyond the current borders.
Ziad, you're living in Dubai. You're very familiar with the region. You've been there a long time. So you can give us a very unique perspective. We live in the Americas and in the UK, and we have that mainstream media impact on us. As you sit in the Middle East, what is the viewpoint there on escalation? Are we on very thin ice? Are we on tenterhooks? Is the risk of social unrest rising in the region? We've seen protests.
Everyone's on edge, Manus. This is a very emotional conflict. It hits people. It's very close to people's hearts, and people care about it immensely. The question is, will emotions get better of people and lead to possibly... So no one wants the conflict to expand beyond this current sort of borders. But given how high emotions are running, there is a risk that that might happen. If it does happen, Manus, that could have a significant impact on the global economy. We could see oil prices rising significantly. We could see global inflation rising significantly. We could see global interest rates remaining high. And we could see actually the global economy going into recession. So in the worst case scenario, where you have a direct conflict between Iran and Israel, our estimates see global growth slowing by about a whole percentage point. That's $1 trillion of lost output. And that would take global growth to the slowest rate in 4 decades. Obviously, no one wants to see that outcome happening. But given how high emotions are running, there's a risk that might happen.
Yeah, I mean, you see it in the Middle East, you see it globally, you see it in New York. Ziad, the number that caught a lot of attention in this great piece you and the team wrote was that escalation threat resulting in $150 oil. How do you get there? What are the inputs that get us to $150?
Well, the starting point, Danny, is looking how much the region produces in terms of oil. So you have about a fifth of the global oil supply comes from the region, Iran, Iraq, and the GCC. Now, you might think that some oil fields are at risk, some of them may not be, but you have a fifth of the global supply comes from that, and a lot of it gets transported through the Strait of Hormuz, which Iran has threatened in the past to close. So even if you don't have attacks on actual oil fields, this oil may not be able to leave the region. So we looked at the historical experience of the 1990-1991 Gulf War, and then oil prices increased by about 75%. If you take this from our starting point, where oil was at $85 per barrel, you add a 75% increase, that could take oil prices to $150 today. That would obviously have a significant impact on the global economy. That would reverse this inflationary impact that we're seeing in the world. That would keep interest rates high, and that would slow global growth significantly.
Okay, Ziad, those are the inputs. Thank you very much. It's a great piece. I encourage everybody to go and catch up on Ziad's piece, along with the economics team, trying to dissect this impact as best they can. Ziad Daoud, our Bloomberg economics team for the Middle East and emerging markets. Coming up, a rare trip abroad for Vladimir Putin. He has arrived in China. He will meet with President Xi, and why the two leaders are having these discussions. We have global tensions rising. Danny, it's worth just checking in on some of the Israeli assets before we pause for thought here. The shekel has had a bruising couple of sessions. We just seem to have paused in that for the moment.
Yep. First day stronger in 6. Worst 6-day sell-off since Jan 2021. This is Bloomberg.
We see that some people consider it an attempt by the People's Republic of China to put someone under its thumb. But we see otherwise. We just see a desire for cooperation. Our own ideas of the development of the Eurasian Economic Union fully coincide with the Chinese ideas proposed within the framework of the Belt and Road Initiative.
Was the Russian President Vladimir Putin speaking in an interview with the China Media Group ahead of the Belt and Road Forum. Joining Danny and I now is Tom Marenzi. Tom, Putin arrives in Beijing. I think the last time he was there, there's a wonderful line. He committed to a no-limits partnership with Xi Jinping. But why Xi Jinping and Putin? What are they banking on right now in this geopolitical storm that we're living through? Good morning.
Yeah, you're right. They absolutely talked about that no-limits partnership just at the time, of course, that Russia was launching its invasion of Ukraine. The dynamics have changed since then, though, Manis. The economic dynamics and the political dynamics. These countries are more enmeshed than they have been economically. So you're seeing, for example, exports from China to Russia have increased by about 57% just this year. In terms of FX trading in Moscow, half of that now is done in yuan. And in terms of China's imports, of course, of fossil fuels from Russia, China is now the largest importer globally for those Russian fuels. Why is Putin on the ground now? To enmesh and further enmesh that economic relationship. He wants to see a new gas pipeline, for example, between Russia and China. And from China's perspective, they need this backing from Russia for their Belt and Road Initiative. It's faced challenges around debt sustainability that are very well known, and he needs that political cover as well. At a time, of course, when we know that the economy of China itself is challenged. That is China's importance in terms of having Putin on the ground. It is a complicated relationship, but it is more enmeshed than it's ever been. But again, at a time for China when they are focused as well on their domestic economic challenges.
Well, on that note, there's still some creditors who say they haven't gotten an interest payment yet from Country Garden. What do we know about what happens next? Do we even know exactly when this deadline is anyway?
Well, we don't have a specific time. The clock is ticking, 17th or 18th, so we're very, very close to that, obviously. It's a debt payment of just $15.4 million US dollars. In the context, Country Garden, once obviously one of the largest property developers in China, has about $9.9 billion US dollar bond-dominated debt that remains outstanding. Its total liabilities, Danny, are about $187 billion US dollars. So it looks like they are going to officially default at some point in the next few hours. The question then is, what does the restructuring look like? What form does it take? If it becomes a messy restructuring, that could prove very problematic for an already under pressure real estate sector. And it also reminds us that the steps that have been taken by Beijing to try and support the property sector have yet to do enough, really, to go the full hog.
And that's the biggest problem for them, isn't it, in terms of these piecemeal, some would say piecemeal and no bazooka in terms of stimulus. Tomorrow, in the next 24 hours, I mean, we're getting nervous because we're going to get GDP, fixed asset investment, retail sales. It's going to be this data dump. A lot of people are saying it could be a call for the bottom of China. What are we expecting?
And to be clear, to that point, Manis, the stimulus measures that have come through, piecemeal as they have been, have done some work, have gone some way to supporting, for example, the manufacturing sector. There are signs that that is starting to turn. Exports out of China has started to moderate the slowdown there. So there's some examples of where there are possibly, arguably, some green shoots. But you're right, the data tomorrow will give us more clarity on how far that has gone. GDP, for example, the July to September, that period is expected to come in at around 4.5%. That's below the annual target that Chinese officials set themselves of about 5%. And you're absolutely right. We will need to focus on particularly retail sales. The strength of the Chinese consumer really important as well.
Tom, thank you very much. Also looking forward to see you break down that data on your show, Bloomberg Markets Today. That is Tom Marenzi. Thank you very much. All right, Manis, some breaking news to bring to our viewers. The private equity giant CVC Capital is said to near a kickoff kickoff of a mega private equity IPO. This rumor has been swirling around for at least the past year, Manus, but we know the conditions to IPO have not been very good. We, of course, were speaking with earlier this month with KKR's Philip Freise, who said that for those who want to IPO, there might be a window of opportunity coming up. For CVC, according to people familiar, that window might be this coming November.
You know, this is the happiest I've seen you since we launched this show. It's like you just light up as soon as private equity news comes up or anything. I mean, just to put it in context, I know, there you go. $160 billion is what they manage, Danny, and they raised, what, $26 billion back in July. That was the world's biggest ever buyout fund. The valuation is going to be key, because we've seen a lot of IPO flops, but this is a very different beast. It's not a retail, it's not a go shopping, it's not a retail product. This is the absolute guts and bones of finance. So it's valued at, what's the number?
Yeah. $15 billion. At least that's what it was valued when it's big. Manus, you know why else you should be excited about this? Because CVC was really the first private equity fund to prove that you could invest in sports and make money from it. They did it in F1. See, there's a sports hook in here. You
got it in there. I think the problem is, of course, the Saudis and the Emiratis come along with a much bigger swag bag and they go, yeah, we'll have a bit of that, thanks.
True. All right. Well, looking forward to keeping everyone updated on this one. All right. Coming up first, though, we're going to take a look at some of the market-moving events to watch throughout the day. You're on Bloomberg Brief. Welcome back to Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. Now let's get you set up for your trading day with a look at what's ahead. Bank earnings are going to pick back up. Bank of America and Goldman Sachs report before the U.S. Open. Plus, we'll get results from J&J, Lockheed Martin, and United Airlines. And U.S. retail sales, those hit at 8:30 a.m. Eastern, followed by industrial production figures. Those come at 9:15. Finally, a big day of central bank remarks coming from the Fed's Williams, Bowman, Barkin, and Kashkari, and the ECB's Knott, Centennial, Guindos, Holtzman, and Nagel all speaking later today. Manus, that is certainly a lot to chew on.
That is a lot of speak, isn't it? And just reflect back, 24 hours ago, we had Union Bancaire Privé. We had Kinsella with us saying we're live in a policy mistake. Today, it's going to be all about the banks. Bank of America, Goldman Sachs, they're going to be up before the bell. And I just wonder what that's going to tell us about the flow of money in deposits. We just caught up with Octavio from Opimas, and he's talking about a shift that's yet to come, Danny.
Yeah, he says that, look, he's surprised the deposits haven't come out yet, considering the front end, you can get more than 5%, but it's likely on its way. I want to know, Manus, is anyone going to ask on the Goldman call about DJ Saul turning in his turntables?
Well, all I can say is, having spent a bit of time with David Guetta, from David Solomon to David Guetta, the beaches of Ibiza are obviously now safe again. There you go. I actually envy David Solomon to be, you know what? That's not a bad gig.
No. I was going to say, there's an opening now, man. It's just for you. You can take it. Somewhere in Ibiza, they're looking for a DJ. This is Bloomberg.